This is where monetary policy becomes subordinate to the needs of government finance. The Federal Reserve can't raise interest rates to combat inflation, because doing so would bankrupt the government through exploding interest payments. They're trapped, and everyone holding dollars is trapped with them. Consider what happened in 2022. Inflation hit 9%, the highest in 40 years. The Federal Reserve responded by raising interest rates to 5.5%, the fastest rate hike cycle in history. But watch what they did simultaneously. They started selling bonds from their balance sheet to reduce their holdings. This is called quantitative tightening. In theory, it should have pushed interest rates even higher by removing the artificial demand the Fed had created. But here's what actually happened. The Federal Reserve sold $1 trillion in bonds, but the government issued $2.5 trillion in new debt during the same period. The Fed's reduction was overwhelmed by new government borrowing. And who bought that debt? Not the free market. Foreign central banks actually reduced their holdings by $200 billion. Domestic banks bought some, but they were forced to through regulatory requirements, not market interest. The real buyers were pension funds, insurance companies, and money market funds that are legally required to hold government securities regardless of whether those securities provide adequate returns. This is the captive market I mentioned. Through banking regulations like Basel III, insurance solvency requirements, and pension fund fiduciary rules, the government has created a system where private institutions must buy government debt or face regulatory penalties that could destroy them. This is financial repression in its purest form, not the dramatic kind where the government directly seizes bank accounts, the subtle kind where they manipulate the entire financial system so that your money flows to government coffers automatically, invisibly, without anyone voting for it or even understanding it's happening. Let me show you the mathematics of how your wealth is being transferred. Suppose you have $100,000 in savings. You put it in a high-yield savings account paying 2.5% interest. That sounds reasonable, but inflation is running at 4.5%. Your real return is negative 2%. Every year, your $100,000 loses $2,000 in purchasing power. After 10 years, your account balance shows $127,728, but the purchasing power is equivalent to only $85,400 in today's dollars. You lost $14,600 in real wealth, while your account balance increased nominally. Now multiply that by 330 million Americans. The total wealth transfer from savers to the government and debtors runs into the trillions annually. This is how $38 trillion in debt disappears without being paid. Not through default, not through economic growth, through the systematic destruction of your purchasing power. But it gets worse, because the system is designed to accelerate. The more debt the government accumulates, the more they need inflation to reduce the real burden. The more inflation they create, the more interest rates must be suppressed to keep debt service manageable. The more rates are suppressed, the more negative real returns become for savers. It's a self-reinforcing cycle that can only end in one of two ways. Either the dollar loses reserve currency status and the system collapses, or they successfully inflate away the debt over the next 10 to 15 years and reset at a lower debt to GDP ratio. The Federal Reserve is betting on option 2, and they have historical precedent on their side. Between 1945 and 1970, the United States reduced debt from 106% of GDP to 37% of GDP, primarily through financial repression. They capped interest rates, allowed inflation to run above those rates, and forced financial institutions to hold government bonds. The result was a 25-year wealth transfer from savers to the government that eliminated 2/3 of the debt burden without paying back a dollar of principal. They're doing it again. Same strategy, bigger scale, more sophisticated execution. And this time, they have tools that didn't exist in 1945, digital currency frameworks that allow complete visibility into every transaction, regulatory frameworks that capture every major financial institution, coordination with foreign central banks through institutions like the Bank for International Settlements that ensures simultaneous policy implementation across multiple economies. The timeline is already mapped out. The Congressional Budget Office projects that, with current policies, debt to GDP will peak around 180% by 2050, then begin declining. But that decline isn't from paying off debt. It's from nominal GDP growth, fueled by inflation outpacing debt accumulation. Translation: they're planning to inflate away $20 trillion to $30 trillion in real debt burden over the next 25 years. Here's how it breaks down mathematically. If nominal GDP grows at 5% annually, 3% real growth plus 2% official inflation, but really 2% real growth plus 3% actual inflation, the economy doubles in size every 14